Hi, I'm Josh Mesk, Vice President of Investments at Invisor. This is our March 2016 market update. With the end of March, we saw the end of a very volatile Q1. It was actually the sixth most volatile quarter in the past 60 years. If you look at the S&P, 26 of the days had greater than a 1% price movement. And now, while that above average level of volatility doesn't really predict any future direction for stock, the current precarious global environment really gives us no reason to expect lower volatility going forward. There's still a lot of uncertainty and there's still a lot of contrasting data out there. If you look at the price of oil, for example, oil is up 10% or so in the month. But at the same time, we really have yet to find that equilibrium price for oil. Politically, politicians in Europe are very active right now as Brits go to the polls in Europe soon to vote whether or not the country will stay a part or member of the EU. But if you look in other places in the world, political reforms have been actually pretty positive. South America is one example. In the U.S., data has still been pretty solid economically, but politically the country is uneasy right now. Case in point with the Trump and the Sanders campaigns going on as long as they have, much longer than anybody expected. So in this update, we'll take a deeper dive into the Brexit, what's going on in Britain right now. We'll take a look at the Federal Reserve policy that was released this month, and then also the Canadian federal budget that was released this month. And then we'll take a look at what we can expect going forward. So starting with the Brexit, Brits go to the polls on June 23rd to vote to whether or not they'd like to stay a member in the EU. Now, the deal would be a pretty heavy blow to an already weak Europe as you uncouple the world's fifth largest economy in Britain with its largest market. Over 50% of British exports go to the EU tariff-free. If they were to leave and choose to exit, they're going to have to renegotiate those tariffs, pay more for membership. There's potential for animosity amongst other United Kingdom countries like Ireland or Scotland. And it'll likely cause a lot of global volatility as the uncertainty around how the dust will settle after something like that unfolds. Now, it's still a pretty low likelihood that this will actually happen. The majority of voters in Britain are for staying in membership in the EU, but the fear is that they're less motivated to go to the polls than the out camp is. So we'll have to see how that all unfolds this summer. Now, looking over to the U.S., the Fed left rates unchanged as expected. The statement was a real boost to global markets who expected the tightening policy to maybe be rolled out a bit quicker than it's being indicated now. While the statement was a bit dovish, they did indicate that the economy in the U.S. is growing at a moderate pace despite global economic risks. So what that indicates to us is that going forward, they're going to keep their view more local on the local economy and making that rate decision, as opposed to global economic concerns, which I think is a good thing because now we see inflation at 2.3%, which is the fastest year-over-year growth since 2008. So going forward, we'll expect this tightening policy to roll out a bit slower than initially expected, but it's still going to roll out at a controlled pace. Now, looking over to Canada, the new federal government released their budget for 2016, and what the budget focuses on is spending over the next 10 years, where the government will be running a deficit to try and spur the economy. They'll be financing that deficit by issuing bonds and trying to take advantage of this low interest rate environment that we're in. If we jump back a couple slides and look at that low interest rate environment in the States, it's very similar here in Canada, where central banks don't have much ammunition to try and stimulate the economy by lowering rates and trying to pump that liquidity in. What this new government is doing instead is trying to stimulate the economy by taking fiscal measures, by pumping cash into infrastructure projects and trying to put more cash into hit the hands of middle-class Canadians. Now we take a deeper dive into the federal budget in a blog we posted last week. So if you'd like more information, I'd encourage you to check that out. But all in all, although we're in this environment where governments are trying to stimulate their economies, pumping more cash in, trying to increase liquidity, fundamentally the data is still pretty solid. Their liquidity globally is very strong right now. Corporate earnings are still pretty solid, although they're not growing as fast as they were before. They're still growing at a moderate pace. I think if there's one thing that we can be certain of, it's that we will continue to see volatility in a market like this. So for short-term investors, you want to steer clear of that volatility. Keep conservative investments in your accounts, like short-term bonds and high-quality stocks. For long-term investors, anticipate that there's going to be volatility in your portfolios going forward. Whether it's positive or negative, you don't want to overreact one way or the other. No swings in the market really should affect what your goal is at the end of the day. So stick the course. Look for ways to take advantage of that volatility, like setting up pre-authorized contributions, and don't get spooked or overconfident one way or the other if we do see some volatility in the market. So that's it for our March update. Thanks for watching, and we'll see you next month.